As you have put your life in order, there are several advanced estate planning and asset protection vehicles you should be aware of.
There are some other vehicles that we can use that can be very powerful if you have the right circumstances for them. For instance, if you have an IRA account, you can take your IRA account and open up your own limited liability company. With that, open up a bank account and put your IRA monies in your bank account, obtaining checkbook control. In order for you to do this, you have to be working with an administrator who will allow it. A lot of your major administrators will not. Your banks and your financial companies will not, because that's how they make their money. But if you find an administrator that charges on a fee-based administration, then we can set up your IRA LLC. It's a very special LLC. It's nothing like what your attorney would typically set up for you. It has to have the language in it that deals with the IRA context for your LLC. But that's something that we can do. So for instance, if you're in the real estate business and you're out looking for property, you find a piece of property and you'd like to buy it right then and there, you have to be able to write a check on the spot. If you, for instance, write a check out of your own pocket, your own bank account, and then you go to your administrator and you get the money to buy the property, you've already created a prohibited transaction. You can't do it. It has to be IRA money from the beginning, and so the only way you can do that is to have your own IRA LLC and have checkbook control. Another thing to consider is charitable remainder trusts. Charitable remainder trusts have been used for years and years. They're very safe, they work. Let's say, for instance, you've been in the real estate rental business for years and years. You've got 10 rentals. They're all paid off. You've fully depreciated them, and now you want to be out of the business and you really want to retire. What do? You set up a charitable remainder trust. You transfer all of those properties into the charitable remainder trust, have the charitable remainder trust sell them. There's no taxable event, so you don't have the problem with capital gain recapture or any of those kinds of issues, which if you're selling your property outright because of capital gain recapture and other issues, you can have as much as a 70 or even 80% tax on that kind of property. Charitable remainder trust, let's say you've sold the properties, you now have $2 million in the trust. You get 8% return on that property or on those monies for the rest of you and your spouse's lifetime. It can be a wonderful source of income, totally secure, fixed annuities that we have invested in. You're not going to lose your money. It's going to be secure for the rest of your life. But here's a very interesting and fun aspect. The way we set them up so that the charity that is the remainder charity or remainderman is your own family foundation. And so in perpetuity, this money is going to go into your family foundation. It's a 501c3 charity. It won't cost you anything to set it up. And forever, you're going to have your own charity. Your children, your grandchildren, your great-grandchildren are going to administer that. Another thing to consider if you're selling a business or you're selling the farm is we can provide you with a deferred installment sales trust, which allows you to defer the tax, the capital gain tax, on the sale for almost as long as you want, well, at least up to 20 years. So you could be making money sufficient to pay the tax over that period of time and have the use of the full sale of your property or your business through a deferred installment sales arrangement. Another thing to consider if you really want protection would be offshore trusts. If you have a lot of property and you want to really protect it, an offshore trust is better than any onshore trust. Years ago, for instance, Alaska set up what is called a domestic asset protection trust, and now there are probably 8 or 10 states that have followed suit The concept was to keep the property in the United States and not take the property out. There has been some success with this, and the Domestic Asset Protection Trust are something for you to consider as well. One of the benefits of a Domestic Asset Protection Trust is usually you don't have to pay state tax if you're in a state that has this legislation, as long as you have that property. You still have to pay the federal tax, but you save on the state tax. But you still are under the jurisdiction of U.S. courts, and as long as you're under the U.S. court jurisdiction, you never know how they're going to decide a case. If you go offshore, you can determine how they're going to decide a case because it will almost never get decided. You set up something in the Bahamas, somebody comes and sues you in the Bahamas, you move to the Cook Islands, somebody comes to sue you in the Cook Islands, you move to the Isle of Man, and so forth and so on. Your trustee is empowered, in fact, required to move it out of the jurisdiction if somebody comes after you.
Thank you for your time today, and we look forward to working with you.